Welcome to the Three Edge Weekend Review for the week of July 25th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. Today's video is entitled Soft Landing or Stagflation, Why It Matters. And Steve and I will be discussing this week's meeting of the Federal Reserve's Federal Open Market Committee, where the Fed raised short-term interest rates by 75 basis points, or 0.75%, for the second month in a row in order to combat inflation that is running at levels not seen in the past 40 years. We'll discuss where we may be in the current Fed tightening cycle and what this could mean for the markets in the remainder of 2022 and beyond. First, a brief look at recent market activity, and despite the Fed raising interest rates again this week, stocks have continued to enjoy a rebound here in the month of July. Investors have adopted the narrative that the Fed will be able to soon begin to slow its pace of monetary tightening to curb inflationary pressure. And it appears that perhaps the bond market agrees with the stock market as the yield on the 10-year U.S. Treasury has now declined to below 2.7% from its high this year of approximately 3.5%. So, Steve, let's get started with our discussion about the Fed's second 75 basis point increase in short-term rates, 2 months in a row. And during the news conference, the FOMC meeting, Jay Powell seemed to be rather emphatic that the Fed intends to fight inflation and bring it down to its 2% target. And if that's the case, they seem to still have a way to go. But at the same time, Jay Powell did say that at some point it will be appropriate to slow down the pace of further increases in rates. And that's what it seems like, at least for now, the market is glommed onto, because they do have a lot of work left to do. So where's the disconnect here? Can you shed some light on that?
Sure. Well, first of all, Fritz, the rally that we've seen over the last few weeks has now exceeded from trough to peak over 10%, and that is typical for a bear market rally. And I think what we're seeing is hope, and again, hope is a typical emotion during a bear market rally, that we are going to get a soft landing, which simply means that inflation will come down, won't require any or many more rate hikes. We'll avoid the recession. The economy will slow down, but not go into recession, and everything will be go on happily ever after. And that's what the market action over the last couple of days has been very consistent with, and over the past few weeks. And so that's the hope. Now the fear is, no, we don't get to walk this tightrope of a soft landing, but in fact we get into stagflation, which means that the inflation remains persistent and the economy in fact does go into recession, the worst of two worlds. So the big question is, does the Fed stop the hikes early like the market's expecting? And does that mean that we're going to get persistent inflation? They didn't do the job. They didn't finish the job. And of course, this is the criticism of the Fed during the 60s and 70s. And they had to do much more drastic action in the late 70s, early 80s. Or will they do what they say they're going to do, fight inflation, which is at 9%, nowhere near 2%, keep hiking rates until something breaks or until the economy goes into an obvious recession or worse. And then that's when you get falling profits in the next leg of the bear market. So that's really the question.
All right. Well, here's another topic that came up during the press conference yesterday. And that was this idea of forward guidance. And I always found this to be very interesting. And it seemed that Chair Powell, he seemed to back away from the more explicit forward guidance that investors have really come to expect from the Fed. And so this seemed to me this is an important topic. And so maybe it'd be helpful if you could explain first, what is meant by the Fed providing forward guidance, and why now may they be backing away from providing forward guidance to investors?
Well, the Fed thought that forward guidance would be helpful by telling the market ahead of time what they're going to do. It would reduce the element of surprise and the markets wouldn't be shocked. Now, at first, before they used forward guidance in a big way, they said they were data dependent, and whatever the data told them, that's how they would act. And that worked for a while. Then we had a situation where the data were screaming out that the economy is overheating, we're having inflation. And so the Fed went into forward guidance mode, ignored the data, and the Fed was very, very slow to act in a way to fight inflation. And now, with hindsight, we can look back and see where they should have started to hike rates quite some time ago. And if you go back then, you'll see that with their forward guidance, they boxed themselves in because they said, and this is a quote of Powell, uh, that we are not even thinking about raising rates.
Yeah.
And the time that the Fed said that was the time, with hindsight, they should have been hiking rates. So the forward guidance really backed them into a box. They continued to not hike rates for some time after that. And now we're seeing this rapid catch up, the most accelerated rate hiking in decades. And so now they're saying, okay, forget about forward guidance. We don't want to be boxed in. We're going back to being data dependent. Well, we'll see what happens next.
Sounds a little bit like making it up as you go, but anyway, so be it. So as always, my final question is based on what we discussed here today about the Fed raising rates and the future direction of monetary policy, and thinking about the equity market rebound that we've had here thus far in July. How should investors consider adjusting their portfolios, or shouldn't they? What do you think about that?
Well, let's admit that there's always enough uncertainty in the markets. Markets are never 100% predictable. You can't guarantee any particular outcome that one should be wary of all one way or all the other way. And we can all hope for a soft landing. That would be the optimistic scenario. That's what the market seems to be focusing on right now. The idea that the Fed doesn't need many more rate hikes, maybe none at all, and that inflation will come down on its own. They'll stop the rate hikes before the economy goes into recession, and everything goes along fine. However, our perspective is we wouldn't want to bet our life savings on all of that working out perfectly. We think it's important to stay diversified. We think it's important to remain patient and have some dry powder so that if, in fact, things don't work out so perfectly and we do get into stagflation, and we get into profits falling and another leg of the bear market, that our clients can take advantage of more favorable prices and buying into those more favorable prices down the road with that dry powder. So that would be our perspective right now.
Can I ask you a quick follow-up question? And that would be the one concern. Well, one of the concerns I have about inflation is that there's many components of inflation that we're experiencing that the Fed really has no control over at all. How do you think about that?
Well, I think that's right. Inflation is really driven by the combination of supply and demand and how they interact. And the Fed can try to control demand.
Right.
And they have blunt tools to do that. They can stimulate the economy and create more demand like they did right after the pandemic. They can try to restrict demand, which is what they're trying to do now, although belatedly. And that's one way to try to affect inflation, but that doesn't affect the supply side.
Right.
Usually, supply issues are not a problem, and just by bringing down the demand, you bring down inflation. This could be more difficult, just like in the 1970s, where whatever they do with demand, we continue to have supply problems. It could be continued raging fighting in Ukraine with Russia, and that could upset food supplies even more. Energy costs could continue to remain high, even if demand comes down for other reasons. Rent is a big part of the CPI, and there's a big lag. We saw a big boost in housing prices, and then over the next 18 months, typically you see rent continuing to climb, which is happening. And then wages sometimes are a lagged effect, but when people see inflation go up, they start to demand higher wages. And even if inflation starts to come down, the demands are built into the system. So There's a lot they can't control.
Excellent. Thank you. I think that's really important to just keep in mind as we look at uh, these issues. So thank you. Thanks for your insight into this week's move by the Fed and what may lie in store for monetary policy, the economy, and the global markets in the remainder of 2022. That will do it for Steve and me. But remember, all our videos are always available on our 3Edge YouTube channel. And in addition, our videos and our written commentaries always available on our website at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.